Welcome back to Flux Reach, the channel dedicated to helping you navigate the complex world of finance and digital assets with clarity and confidence. Today, we are embarking on a crucial journey to understand the essentials of cryptocurrency investing, starting from the very first purchase all the way through to successfully managing your tax obligations here in the United Kingdom. This subject is incredibly important because the rules surrounding digital currency are constantly evolving, and maintaining compliance with Her Majesty's Revenue and Customs, or HMRC, is paramount for every investor. We will ensure this discussion adheres strictly to all content policies, focusing purely on education and responsible financial management practices. The foundational step for any new investor involves the secure purchase of cryptocurrency. This process typically begins with selecting a reputable and regulated cryptocurrency exchange that operates within the United Kingdom or holds a strong global standing. It is essential to conduct thorough due diligence on any platform before committing your personal funds, checking for robust security features and transparent fee structures. Remember to start small, only invest in capital you are entirely prepared to lose, as the cryptocurrency market is known for its inherent volatility and rapid price movements. Always prioritize exchanges that offer multi-factor authentication and clear customer support pathways for your peace of mind. Once an exchange is chosen, the next critical step is completing the necessary Know Your Customer, or KYC, and anti-money laundering, or AML, procedures. These are legal requirements designed to prevent financial crimes and are a sign of a compliant and trustworthy platform, ensuring a safer environment for all users. You will typically be required to provide a form of government-issued identification and proof of your residential address. Funding your account can then be achieved through various methods, such as a traditional bank transfer using British pounds sterling or GBP, which often involves the lowest fees compared to card payments. Security is arguably the most vital aspect of holding digital assets, surpassing even the importance of investment strategy. The most significant threat to your funds is not market fluctuation, but rather unauthorized access and improper storage. It is highly recommended to move the majority of your assets away from the exchange and into what is known as cold storage, meaning an offline device. Hardware wallets, which physically store your private keys and are never connected to the internet, represent the gold standard for long-term cryptocurrency protection. A cold storage device, commonly referred to as a hardware wallet, works by keeping your cryptographic private keys entirely separate from online environments where they could be compromised. When you need to make a transaction, the device signs the transaction offline, and only the finalized, signed transaction is broadcast to the internet. This mechanism ensures that even if your computer is compromised with malicious software, your private keys remain secure and inaccessible to unauthorized individuals. This extra layer of physical security is a worthwhile investment for anyone serious about the long-term protection of their digital wealth. Another crucial security measure is the meticulous safeguarding of your seed phrase, sometimes called a recovery phrase or mnemonic phrase. This sequence of 12, 18, or 24 words is the ultimate master key to your funds and can regenerate your entire wallet on a new device if your original hardware wallet is lost or damaged. You must write this phrase down physically on paper or metal, storing it in multiple secure, separate, and fireproof locations, never taking a photograph of it or storing it digitally on any internet-connected device, as that defeats the purpose. Beyond just buying and securing, many investors choose to participate in staking, which is the process of actively participating in transaction validation on a proof of stake, or POS, blockchain network. In return for locking up your digital assets and helping to secure the network, you earn additional cryptocurrency rewards over time. This can be a compelling way to generate passive income from your holdings, but it is essential to be aware of the specific tax implications for these rewards under United Kingdom law, as they differ significantly from capital gains. Her Majesty's Revenue and Customs, or HMRC, views staking rewards as income the moment they are received and recorded in your wallet. The value of these newly acquired tokens is measured in British pounds sterling at the exact time of receipt, and this amount is generally subject to income tax. This miscellaneous income must be declared on your annual self-assessment tax return, much like other sources of non-employment income, ensuring you comply with all governmental requirements. The rate of income tax you pay depends entirely on your overall annual income and which tax band you fall into. Once you have received staking rewards and they have been taxed as income, they then transition into being considered a capital asset for future tax purposes. If you later decide to sell, exchange, or spend these specific reward tokens, any further profit or loss generated from the time of receipt until the time of disposal will be subject to capital gains tax, or CGT. This dual taxation treatment necessitates rigorous record-keeping to track both the initial income value and the subsequent capital base cost for the tokens. Now we must turn our primary focus to the application of capital gains tax on cryptocurrency assets in the United Kingdom, which is the most common tax event for investors. HMRC classifies cryptocurrency as a type of property, meaning that disposing of your holdings can create a chargeable gain or an allowable loss. This taxation is triggered not only by selling your digital currency for fiat currency like GBP, but also by exchanging one cryptocurrency for another or using cryptocurrency to purchase goods or services. The moment you dispose of a cryptocurrency, you must calculate the gain or loss by subtracting the cost base from the disposal proceeds. The cost base includes the original purchase price of the asset plus any allowable costs incurred during the acquisition, such as transaction fees. The disposal proceeds are simply the value of what you received in return, measured in British pounds sterling at the precise time of the transaction, which is a critical point to remember for record-keeping purposes. One of the most important aspects of capital gains tax for crypto is the annual exempt amount, or AEA. This is a tax-free allowance that every individual in the United Kingdom is entitled to each tax year, meaning you do not pay capital gains tax on profits below this threshold. For the 2024 to 2025 tax year, this allowance was substantially reduced, making it even more important to plan and track your disposals throughout the year to manage your tax liability effectively. HMRC also employs specific rules to match the cost of acquired assets against the disposal event, preventing investors from simply choosing which purchase price to use. These matching rules must be applied in a strict order to ensure the correct tax calculation. The primary rule is the same-day rule, which dictates that if you purchase and dispose of the same type of cryptocurrency on the same day, the cost of the earlier purchase is matched against the later sale. Following the same-day rule is the 30-day rule, also known as the bed and breakfasting rule, which applies if you buy back the same type of digital asset within 30 days of selling it. The cost of the assets repurchased within that 30-day window is then matched against the original disposal. This rule is designed to prevent investors from artificially realizing a loss for tax purposes while maintaining uninterrupted ownership of the underlying asset. If neither the same-day rule nor the 30-day rule applies, the remaining assets are considered part of a Section 100 and for pool, often simplified to just the pool. This pool represents the average cost of all the remaining tokens of that specific type, and the investor must calculate the pooled cost for the asset being disposed of. This average cost approach adds significant complexity, reinforcing the need for specialized tracking software or professional tax advice. It is absolutely crucial to understand that exchanging one cryptocurrency for a different cryptocurrency, perhaps Bitcoin for Ethereum, is classified as a taxable disposal of the first asset, with the full fair market value of the second asset in British pounds sterling counting as the disposal proceeds. This means a taxable event occurs even if no fiat currency is ever touched. This common error often leads to unintentional tax non-compliance for many novice investors who fail to track these coin-to-coin swaps. A key tax savings strategy available to investors is tax loss harvesting. This involves deliberately selling a cryptocurrency for less than its original purchase price, therefore realizing an allowable capital loss. This capital loss can then be offset against any realized capital gains made in the same tax year, effectively reducing your overall taxable gain and lowering your capital gains tax bill, a responsible strategy for managing portfolio volatility. If your total realized capital losses exceed your total capital gains in a given tax year, you cannot claim a tax refund for the difference. However, these net capital losses are not wasted. They can be carried forward indefinitely to offset future capital gains in subsequent tax years. You must formally report these losses to HMRC, even if you have no gains to offset them against in the year they occur, to establish the ability to use them later. The importance of keeping accurate and comprehensive records cannot be overstated, as this is the backbone of responsible cryptocurrency investing and tax compliance. You must maintain detailed documentation for every single transaction, including the date and time, the type of digital asset, the quantity, the value in British pounds sterling at the time of the transaction, and all associated transaction fees. Poor record keeping is the most common cause of difficulties when dealing with HMRC inquiries. Specialized cryptocurrency tax software is widely available and highly recommended to automate the calculation of your cost basis and capital gains, especially when dealing with thousands of transactions or complex pooling rules. These tools integrate directly with major exchanges and wallets, significantly simplifying the entire process of preparing your annual tax submission and generating the required reports for your self-assessment. This investment in good software is a small price to pay for the peace of mind of accurate compliance. Finally, we must emphasize the responsibility of reporting and paying your taxes through the annual self-assessment process in the United Kingdom. If your total chargeable gains from all sources, including cryptocurrency, exceed the annual exempt amount, you are legally required to file a self-assessment tax return. Failure to accurately report your gains and income can lead to penalties, interest charges, and serious investigations from HMRC, so always prioritize transparency and compliance in your financial dealings. This journey into buying, securing, staking, and navigating the detailed tax landscape of United Kingdom cryptocurrency investment is crucial for your success. Remember that responsible investing starts with responsible compliance, and understanding these rules is your greatest defense against future complications. Continue to educate yourself, seek professional advice when necessary, and stay informed as the regulations continue to adapt to this rapidly developing asset class. Thanks for watching the video. Subscribe this channel, like the video if you found the video great. If you have any questions, leave me your comment through the comments section.